Welcome back, everybody. I am up early, traveling Park City, Utah, doing some skiing, and it was very difficult to find coffee this morning, so I found it. Not saying it's going to be a perfect spaces, but it's going to be much better than it was going to be without the coffee. So glad to be here, glad to be back. It's a big week in the markets. I hope everybody can find some short stock trades, shorts that are in a downtrend. I wanted to couple of ideas this week struck me as kind of interesting. Now, my first one was enjoying the article about Citadel and Griffin doing more in commodities and hiring weather experts to come in and help with their commodity trading. Yeah, I thought that was very interesting. I guess the point I wanted to sort of contemplate was, can trend following compete with the best fundamental managers, the best traders, the weather PhDs? I think it can. I'm probably in the minority there, but I just wonder. And a lot of what I feel like in the article was a certain piling on of commodities as well. So just like last year, if you traded a lot of bonds, you did really well. And if you really load up on things, you could do it at the breakout and it would really look like you knew what you were doing. But for a lot of us here on the trend following trading ideologue spaces, we trade small. We trade a lot of markets, and we don't. Even if we had the weather information, we probably would still take the small bets and massive diversification in all the other markets and sectors, long and short. So, anyways, I thought that was kind of interesting. And then yesterday, Alp was doing some. I'm sorry, Absolute had some good tweets about the benefit of multiple systems, trend following, how that works. People were a little confused on how you could be long and short. How can one trend follower be long and another one be short? And of course, it's way worse than that. The same trend follower can be long system one, short system two, and it really is a big edge, as Absolute so eloquently put it. All right, and let's get this ball rolling. All right. Good morning, Oleg.
Absolute, Jerry Smith, and all the other guys. I'm very happy to be here, and I'm in very, of course, I'm in a very beautiful. I wanted you to see this place, and I did a photo of this place maybe 20 minutes ago, and so you can see this place. It's Black Sea coast, Krasnodar region, South Russia. I live not far from here. My home is not far from here, so I decided. Usually, I go when we are in our spaces. I go to places that I love most because trend following trading discussions I love also, and I like to eat chocolate, drink tea maybe before that. So maybe French chocolate or Belarus. So I was thinking, of course, a lot about trading, about stocks, about commodities, about breakouts, and I always think very often. I think about time frame diversification. Also, I remember that in 2009, I firstly mentioned time frame diversification works good. It really works good. Also, of course, I didn't know much at that time, 13 years ago, about asset class diversification. I didn't know is it worth it or not. But time frame diversification is a good thing. So, and all kind of diversification are good things for us, for trend followers. So, and I'm sure we will. Our discussion is very interesting. It's incredible interesting. Our discussion. So let's start it.
G'day, Oleg. G'day, Jerry. Hello, everyone. Great to be here. Yes, look, I read that article, Jerry, on Citadel. That was very interesting. As I read it, I was thinking of Jim Simon's Medallion Fund and how they specialise in these alternative data sources. They're very, very research heavy. And when I started reading Citadel, looking at how they are engaging all of these experts in forecasting weather and their impact on commodity cycles, all of those things. I was starting to think, well, perhaps they're going down the Jim Simons path of using a lot of different alternative data sources, not just price itself like we do, and looking at how they can take that to their advantage with their trading method. I do note that they were up 37% last year, so they obviously did very well with their commodities. So, and it's interesting to see how now they've eclipsed Bridgewater in their performance. So, yeah, it's very interesting.
Yeah, it is. Once again, I would just wonder, can Trend hang in there and get on those commodity trades? Why not? Mulvaney, no one beat Mulvaney, so he he's putting the leverage, the metal to the floor on the leverage, and so he's hitting all the trends. And I mean, how wrong can we be, right? Short-term trading with that data, like Renaissance or Medallion does. Not too interested in that, but getting the broad trends right, it's hard to see how the trend followers wouldn't do pretty well, like that, like they've done when there's been nice big trends. On the multiple systems, this is something I was introduced to in 1983. I like trading, obviously as many systems as possible, just like you trade as many markets as possible. I do think that, as we've said before, it has the limitation in that for a trend follower, you definitely want to be long. Oh, you want all the systems to be long when there's a big trend. And then it's just going to limit the amount of diversification you get. You're going to have small diversification on different entry dates, different entry prices, maybe, although all the breakout systems can really signal on the same day. And it's really going to step in and help with the exits when you've had nice big trends and you get multiple exits at different places. But, some of these systems are longer term and they're going to give back more profit. So it's not going to really be the type of diversification that you're going to like sometimes. Yeah. So anything else on anyone's mind about trading? Oh, the elephant in the room. What happened? What happened to our friend Michael? Michael was our good friend. He still is, but he was really supporting our long-term trend following and our ideologues for months and months, and now we've lost him. So I'm not sure what happened, because he was kind of a fan of trend following in this spaces for quite a while. So we need to get Michael back. We let him down, but yeah, I think that over time, the back testing is one thing, and then the real live performance is another. And trend following will continue to show its mettle in the future and be one of the better performers. So I think people come in and out of love with trend following. And I have friends who are so disappointed in trend following. I can feel it. I can read it in their tweets and in what they say, is that they're mad at trend following. They wanted it to be better. They wanted their trend following to be better. Yeah, it's still difficult, mostly psychologically, to take small losses and let profits turn into losses.
Jerry, did you obviously listened to I think it was DG Partners on Top Traders Unplugged. That was a very interesting session with Niels and Alan. And there was just something in there which really caught my attention. And it was in relation to DG Partners saying that they had two roads to go down, whether they'd go down multi-strat or whether they'd focus more on trend. And what they decided to do was, instead of going down the multi-strat path, they looked at how to really concentrate their efforts in trend, particularly with models that weren't in the market all the time. Did you hear that?
I did, and I really enjoyed that. I haven't been able to do the in-depth analysis that I usually do. I'm waiting until it comes out on YouTube so I can have the YouTube generated transcript. But it was a very good, and I like that firm. The Top Traders Unplugged CTA continues to be really great. I listened to Nick Baltus. He was very good. Niels had a birthday a couple days ago, so happy birthday, Niels. Yeah, it's really, really a good service. Very interesting. And I hope everyone, non-CTA people, non-trend followers, are listening and enjoying it. What struck me about that firm was his tagline was, we just wanted to be the best trend follower possible. So I thought that was pretty interesting. And I guess they traded like 100 markets. And I'm sure they do some vol management, correlation management after the entry. Just seems to be a theme, that you're just never going to get away from. One of the things that Richard Dennis and a lot of people do, he did this. He said he would really enjoy recording all of the cliches about trading and then doing research to prove them wrong. And so I think that that's the kind of mentality you want to have, whether it's a cliche or something people are saying a lot or telling you. That's a good starting point for research is it actually true? So I think a healthy skepticism or absolute, I don't believe it unless you can prove it, way of dealing with these things is perfectly correct. Okay, so when someone says take small losses and let profits run, that you should be skeptical about that as well. Okay, there's a lot of evidence that it works, but still you need that evidence. So I think that statement there, it is sort of a cliche and not to be taken too seriously, but I'm sure the first people who started doing intensive research said, oh, wow, that does work. And it just is the foundational statement for what we do. And it right there immediately gives the impression that you should look into taking small losses, separating losses from profits. Two different groups here. We have the losing trades we're going to handle by getting out quicker. The winning trades, we're going to let the profits run. And I think not paying any attention to the ups and downs and the volatility and the correlation of open profits is totally a good reading on that cliche. And yet the industry, the CTAs have evolved into, they're just not going to do that. They're going to have to pay attention to, and for themselves and for their clients, the idea of possibly having a smoother strategy that is going to step in and let profits run, but not all of the profits. And they do let some of the profits run, but the distribution of the trades is not as non-normal as what was traditional trend following. And it's kind of, they call it on European trading, European CTAs, but now it's kind of all over the entire industry, and Americans, Australians, and Europeans, everyone kind of does it. Canadians, everybody kind of vol manages to some degree. So I find it kind of interesting and fascinating. None of those SocGen CTAs are going to let profits run in a way that I would recommend.
It was interesting with that episode with David Gorton from DG Partners. He was saying how they chose a path that they decided not to go down the backtesting path, and they went into an area what they called conceptual trend. And in a way, I believe that is very similar to the approach we're professing here, which is philosophical trend. In other words, we can develop models through logic that don't necessarily need to be highly sort of optimized for historic data, simply looking at conceptual logic of trend, how to cut losses short, how to let profits run. Well, that's a simple one. How to trail our profits, those sort of things. And I think a lot of the design process can be done without any need for any form of optimization or testing against historical data. To me, that process of backtesting is more a validation of that logic. If it validates that logic, that's sufficient to say it's a robust candidate to use for our models, as opposed to aggressively using historical data to basically data mine the chosen variables.
Yeah, I couldn't agree more. And that's exactly how I do it. And I think the we had with Bruno, we a year or so ago we came up with this trend following 10 commandments, or the principles in the process. And so much of what I believe about trading, it prevents me from even considering some types of back testing. However, I will say this is I've heard you say this before, Richard, and it does confuse me a bit, because you have a lot of capability and you've done a lot of back testing, and you do this annual back testing to update. You have some words for it. They don't come to my mind right now. So it's not stale, and then you'll make these
Keep the
changes.
portfolio sharp.
Yeah, exactly. Yeah, exactly. Niels called you out on that one. So, yeah. So, and you do this process, and then you make changes. So, explain that apparent contradiction, please.
Yeah, so the way I tend to view it is all of my models. The broad nature of all of those models are firstly developed through design elements. Basically defining the constraints of how adverse I want my trades to go and how open I want my profits to go. So that's really something that can be achieved through design. Then in defining where those constraints fall in my models, because I'm looking for this asymmetry in my models. So I'm looking for this principle of open-ended profit potential with focusing on non-linear outcomes in the profit side of the equation. But on the loss side of the equation, I'm always looking at trying to keep the losses linear. And what I'm meaning there is all of the same sort of magnitude. In other words, with that asymmetry, I'm looking for downside linearity and upside non-linearity. So the upside, I can't really get any information out of the back test to help me on my upside. And that's why I keep on saying, well, because I'm specifically targeting these features called outliers, I can't talk in terms of expected returns, because there is no way I can statistically, with confidence, determine a level of expected return of outcomes, because these outliers are unpredictable, all of that sort of stuff. So, but what I can do from the back test is take out information that defines what the normal market movement is, what's the level of noise in that market, what is the level of mean reversion in that market. Now, that information is coming from the back test, which does have statistical validity, because it's working on the bulk of the distribution of returns. We get a very large sample size for me to say, all right, this is the level of normality in this market. Anything outside that level of normality, I will say, well, that exists in my zone called outliers, or the tail region of that distribution. So if I know where that boundary is, I can then say, right, I want to give my models maximum freedom to move within normal market constraints. But then I want to stop any adverse left tail exposure on my trades by ensuring that my trades don't go non-linear. In other words, keep them linear, keep them small. But I must give room to breathe to be able to focus, therefore, my profits on the upside, the non-linearity. So to do that, I need to separate out what I call the normal regime of the market, which is dictated by linearity, and then I can then say that's my boundary for my stops, that's my boundary for my trailing stops. So the reason I sharpen it each year is because each year, as I get more and more data, it's giving me more and more information about new regimes that haven't been experienced before in my back test. And in those new regimes, the level of normality in those regimes is altering. And, I'd say that the trends of, 1980s were probably easier to catch than the trends of the 2010s, 2015s, 2020s, simply because the nature of market participation has changed. There's a hell of a lot more different behaviours now in the market. Influences from central banks, influences from HFT, influences from a lot of convergent models. That's changing this regime of normality. And to me, that says I need to therefore, as I increase my data set and refresh my portfolios, I'm continually adjusting that boundary between normality and non-linearity, which I think works, and it allows me to have a process that at least I have a degree of confidence that there's a degree of adaptiveness in that process. And we all, there's been a lot of talk lately over the last few weeks about the decade-long winter of CTAs. Now, I only see that in the SG trend and the SG CTA index, which isn't really 100% trend anyway, but the SG trend is. But really, I can find other programs that aren't in that category that haven't experienced that winter. And those programs obviously have dispersion from the types of programs we see in SG Trend. That is sort of ticking my box because I'm also finding that as well with my process. I'm finding I'm not getting that decade-long winter that people are talking about. And I think that's because there needs to be more adaptive processing in the process to develop your models, to basically ensure that they don't get too stale or basically optimize to a historic regime that's now no longer valid, if that makes sense.
But are you going to overweight recent data since the markets have changed quite a bit and the influences of the markets have changed quite a bit? Then I just want to...
It's not an overweighting, Jerry, because all I'm doing is I'm adding an extra year of data. So what I'm saying is, okay, let's assume that I had 20 years of data and I undertook my process that would develop these trend following models. Then next year we get 21 years of data. So all the time I'm saying, if there is a new regime expressed in that new data and my models that were based on a 20-year time frame are no longer they're starting to exhibit sort of non-linear symptoms in adversity, which I don't want. That's because we've got a new regime which we haven't seen in the historic record. That means that the nature of trends has changed slightly. So from 20 years of data, I'm then using 21 years of data, then 22 years of data, then 23. I'm not using a weighting. Well, there is a slight weighting. There is a slight weighting to the last 10 or 15 years, but it's certainly not a weighting over the last 2 or 3 years. But all that's doing is it's saying all of those models that have passed that 22 years of data are classified as robust. So that's a big tick box that says, right, they're robust. The second stage is, all right, well, over the last 10 or 15 years, which of the models out of that robust selection have outperformed the other models? And then I'm saying, right, there's some sort of adaptive advantage in those models. So I'm selecting them. So I'm trying to mimic evolution, trying to mimic the fact that, the environment is changing and your models need to slightly adapt to not only be robust, but slightly adapt as well.
That's interesting, Rich. Sorry. Quick comment. I'm interested in the fact that you're considering you keep saying environment. It's written a white paper on just crashes and on sort of tangentially related to outliers and how these movements, these tail movements, really are endogenous in nature. It really just stems from market participants sort of infecting one another with and influencing one another, and it really has very little to do empirically with the regime, so to speak. But I do like the 10-year period, and I like that you're not over optimizing. Another thing that sets you apart, Jerry, is that you're trading all those single stocks. You're not doing a Cliff Asness and putting decoupled from equity markets on the label. You're just strictly seeking outlier events. So I think it's pretty neat. Anyway, that's it.
And I want to say that limiting downside, I trade for 16 years, and every single day I think how genius it is to limit downside and to unlimit upside, because nothing can be eternal, maybe something like that. I mean that our downside, if it's limited, if we have, like Richard said maybe 1 year ago, -1 +1 -1 +3 -3 +20. And so with this, we see this again and again, this wonderful thing that sooner or later we see a massive outlier. And if we have a lot of markets, especially single stocks or some commodities, but in the long run, all market the same. All market the same because we apply universal rules for all the markets. And I even said that when I saw traces of the rain on my window, and I saw that it looks like a chart, and I can, if I imagine that it's a chart, for example, of Apple or Microsoft, and I apply a model, transforming model to this, it looks the same. I can apply model, and it looks the same, and I thought that it means that we are, and I say this over and over again, that our strategy is based. Oh, I'm sorry, dog here. Our strategy is based on rules, universal rules of nature, and I see this. I see this even in the nature, and I love very much trend following strategy. Is one of the reasons, and I believe in trend following strategy. Very, very strongly believe I have, since because of this, because I see even in the nature the same rules are working.
Thanks, Woody. That was good. Yeah, I'm doing my perfect portfolio. That's what I'm into. Niels asked all the CTAs, should you pay more attention to Sharp? Should you pay more attention to absolute returns? Are we paying too much attention to crisis alpha? So they're probably a lot of selling going on, getting ready for this possible sell-off in stocks, and given the fundamentals and the news out. So I'm still pursuing just the best trend following, most diversified single stock, including single stocks, because I'm pretty convinced that the best way to help during a crisis is to trend follow your single stocks and have some shorts on as well, and not just allocate to CTAs who, to some degree, are tilting their systems and trading slightly worse systems, possibly, in order to get short the S&P quicker and get, be a little quicker. And then a lot of them in these podcasts have said, we are hurting our own performance a bit. We are willing to do that in order to help clients and to be part of what clients have deemed that we're here for, which is to help their portfolio,
or hurt them by having an asset that is not capital efficient like yours, not actually providing positive skew, and it's just mimicking the rest of the shit they have in there. But the advisors make money, I guess.
I want to say that we are very consistent, and we have clear plan in risk management and diversification in our technique of catching these outliers. And in every crisis, trend following, like Neil said, that it gives you when you need it most, it is with you. Trend following in crisis, trend following gives you a very good protection against this crisis. Broadly diversified portfolio, risk management, and adaptiveness. Every hour trade is adaptive because we use average to range stop at least. So our strategy is really wonderful.
One of the things I wanted to mention when Richard was talking, it made me reminded me that the classical trend followers, they will have a tendency to show charts and graphs and speak in terms of the trade. So it is the individual trade that has this positive skew and this and this is what we're looking for is size measure showing these trades in my case in terms of ATR, the entry ATR, and sort of seeing the outlier trades. And in managed futures CTAs, it's more about the return statistics. So I remember many years ago when I started noticing this, I was like, what the heck's up here? And so I think that's something to always keep in mind. That and I think that I've been hesitant to be more bold about what I think, how to measure risk and how to look at systems and choose systems. And I think I've always done it the same way. And it's just looking at those trade stats: average win, average loss, average trade, win percentage. Ignore any sort of price movement in between the entry and the exit, and just focus on those trends. I had a nice conversation offline with Alp, and he was asking me some questions. We were talking about what is an outlier, how big does the trade need to be for it to be considered an outlier, and I think it depends upon the length of your trades and your average holding period and your look back. And he he mentioned that what he considered to be an outlier was smaller trades than mine, of course, because he uses the hourly bars. But it was very consistent with the way I used to trade when I first started with the shorter term breakout systems. And I just got to thinking, I was interested if Alp wanted to tell us his average holding period. And I would try to think back and try to compare that to what my average holding period used to be when I first started. And then I thought it was pretty interesting, given that, this hourly bar thing may be just a lot more accurate in picking up trends. If you're going to trade shorter term, it doesn't have anything to do with the way I trade, of course, because my look backs are so long term. But I think that maybe if you're looking at a 10 or 20 day breakout, maybe focusing in on the hourly bars, maybe it would be a lot more accurate. What do you think, Alp?
Hey, Jerry. Hey, everyone else. It's good to be here. So, I mean, in terms of hourly bars, yes, that's the entire reason why I do the hourly bars is because it's very flexible, and you really cannot trade 5-day breakout, right? Nicole Collagen talking about the 5-day breakouts when with Niels on the TTU, and I said, hey, okay, so we have some similarities in trading, but you don't trade 5 days breakout with daily bars. It's not possible to do that. So you're gonna trade it with hourly bars, and if you want to trade 2 to 3 days, then this time you're gonna trade it with 5-minute bars. So the whole point is you want to see inside of the bar, and you want to see whether your stop loss has been triggered or not. Otherwise, it's not possible to do that. So our hourly bars is helping me to trade short term. I do have capabilities to be able to trade 5-minute, but it's a system design choice anyhow. Okay. So in terms of the holding periods, I mean, it depends whether you're taking 100 hourly bars, 200 hourly bars, or 300 hourly bars. It could be from 1 week to a month, or maybe a month or two, and so they are really short term, so they cannot be compared with, let's say, 1 year holding period on average. And I say my average would be possibly 3 to 4 weeks. That's it. That would be my average. And so this week, I've done a lot of work on stock selection process and how to document it and what to do around that to be able to incorporate single name stocks into the portfolio. So one of the research that I've done during the week actually was, so how do we know the stock bear market is over? the stock market is over, I figured I've looked into more than 10 different bear markets. When, let's say, an index, let's say an S&P, hits the 52-week high. So when S&P hits the 52-week high, I can say more confidence, not in 100% probability, but more confidence that the bear market is going to be over. So just keep in mind, at the moment, we are far away from hitting the 52-week highs on the S&P. We're just going down the bear market. But it is, I figured 52 weeks high is a very, very prudent way of calling out the end of the bear market. So that's one thing. And so the second piece of work that I've done during the week is, what are the methods of stock selection? So I'm still working on it. And as we discussed, we have either we're gonna use an index or we're gonna use a momentum-based approach to select it, or we're gonna do a complete discretion and we're going to say that, okay, I've looked into that company and I'm going to trade it. And while going through this, I've tested different definitions of momentum. Is it possible to use momentum and then add it into the portfolio so that we can trade it? And I figured trend following trades first and momentum trades after. So trend following signals are leading signals and momentum signals are coming behind, because momentum is only capturing it only after the fact. But if that stock is already on the portfolio, we're already actually trading it. So that was an interesting observation, actually, about it, And in terms of Richard's conversation around CTA winter, it is my view that it's not possible to get rid of that CTA winter without adding the single name stocks. And even you think that you don't have a winter, you could do much better when you have the single name stock. So, so I think classic trend following has to have an element of trading single name stocks in some shape form. Thank you.
I want to say that I traded short term and I have short term decisions that works. I like long term more, maybe. But I want to say that I have said this before. I think that we need here good filtering. We have a lot of these little outliers in short term space. And so one of the main benefits of this that we need less diversification. We need less money to trade. So, but I think that good filtering will improve this really more than we need filtering more than in long-term space here. And I think that I know exactly that when you diversificate across in a short-term space across time frames, it's it can be very uncorrelated. One short times, for example, 100 hourly bars and breakout, and 200 hourly bars breakout. It can be it can bring very different results, and it's also a benefit of short-term trading. So. But it's when we do a very classical way of short-term trading, it can be some issues. So here's my point that these decisions, so filtering, I think, is good here. Filtering and time frame diversification, firstly, maybe, and of course asset class diversification.
I heard a point from Alp in terms of the bear market. And something interesting popped in my mind, because what constitutes a bear market, what constitutes a bull market? I do think personally that also depends on how you view the market in terms of what time frame or what's your holding period. Because if you're obviously very long term, then you could look over time frames of overall timeline of 30 years. So something that could look like a bear market for a short-term trader could look like a bull market for you, because you're looking at a greater base of data. So it's quite interesting to see. Obviously, when you hear the news, we are in the bear market. The question is as well, what time frame are you looking at, or what's the timeline that you're looking at? What's your view in that sense?
It's just the bear market is business as usual, 20% down from the higher highs. And I was just talking about the stock, the equities, because surely, we trade credit, forex, and commodities and equities. So at the moment, we are going through this equity bear market. And it's always, so I was just curious in my research to understand when I can actually say that the bear market is over. And I happen to test it quantitatively, and I say when the S&P hits the 52 weeks, daily bar high, okay, then the bear market is over. I mean, does this information helps us? Maybe it would. It's still a small detail to keep an eye on. At least we can call it at the moment and say that, all right, so this is a stock market winter. Stock winter, we have the CTA winter. So this is a stock winter as we move on. Thanks.
Yeah, I never have liked those terms, and they don't mean anything to me. It's long, short. What's the proper positioning based upon my system? Some of them can be contradictory for a while. Just get those right trades on and hold on to them and that system. And so I think this 20% never made much sense to me. I never would pay too much attention to it. Absolute. You've been awfully quiet, awfully patient. What's going on?
Yeah. Hi, guys. Yeah, I'm trying to remember what discussions I had with you guys over Twitter this week, and I was listening to the comments today in the spaces right now. Discussing about trend following and the beauty of it. What for me, my journey, like how I actually discovered to love trend following and the concept of cutting your losses short and letting your profits run. It's really a universal wisdom that can be applied almost everywhere and universally in every aspect of life and society. And what I loved about it is what I noticed, people that find trend following appealing and people that find convex and asymmetrical trades appealing are the humble people. And why I'm saying this, because no matter what model you have about anything, it could be a fundamental or earnings or about investing or about anything or about business, or you start a business or so you're putting money in, but you're not making any profits. So you're putting more money in. And then when do you stop? So when shall I stop? Do I just keep putting money in? So a humble person says, yes, I have a good model. It's probably going to work, but there's so many things that I don't know. There's so many ways that my model could be wrong. I could have overfitted it. I could have taught something wrong, or I'm an imbecile and I don't know it, or I don't. There's so many things that I don't know. Is there a universal way to protect myself from reality, from all these unknowns? And there's no other way. Not only no better way, there's no other way than trend following, than allowing the market, allowing the feedback from reality. So reality is giving you a feedback. Am I making money or am I losing money? The feedback from reality, the slap in your face, the slap in your head, which is a loss, okay? You could be the smartest guy with a 200 IQ, with the perfect model, but you're at a loss. The market is telling you there's something wrong. So be humble. And even though you're 200 IQ and even you have the perfect model, the market is sending you a signal that there are some things that you haven't taken into consideration. Reality is hitting you back with a loss, which means you're wrong, which means you should be out. Whereas if the market is confirming your hypothesis every day with remaining profits, or even better, with growing profits, then your confidence in the model should grow. while still being humble. So the beauty of the concept is not really just about trading, like when to buy or when to sell or how to make money. The beauty of this thing, and it doesn't even have to be like a stop loss. The trend following concept in itself actually cuts losses short and lets profits run, even if you don't have a rigid stop loss. No matter what measurement of trend you use, whether it's a breakout or a moving average or whatever, if you have a condition for when the trend is up and the condition when the trend is down, even without a stop loss, you will be taken out much sooner when the market is going against you than if the market is going in your favor. If the market's going in your favor, you're going to ride that trend for years. If the market's going against you, you're going to be out pretty soon. It's impossible for the market to be sending you the opposite data. It's impossible for market to be punishing you with adverse price action and you to remain in it if you're a trend follower, whether you have a stop loss or not. Maybe more than 25 years ago, and I I don't come from economic background or financial background or whatever, but when then I started studying different ways to make money, different strategies, fundamental and this and that. And the one realization that really hit me was that no matter what other strategy you may have or backtest of making money, which is convex, so which is not mean reverting, which is not like picking up pennies in front of a steamroller. So any strategy that's not mean reverting or concave, like basically just looking for little things to just kind of pick up. Any could be fundamental, could be earnings growth, or could be even Warren Buffett strategy that he's holding. Any strategy, anything that you can think of and backtested, any other alternative source of data is improved if you add trend following to it as a factor. Everything is improved. So take strategy X, trade it and backtest it on itself, and add a simple momentum filter or a simple trend following. So you say, yeah, all those factors are good, but don't go in unless you get a trend following signal as well. Just sit tight. Wait for the market to give you the confirmation. And then vice versa. When the market tells you that you should be out, you're wrong, you'll be out, regardless of what the other fundamental things are telling you. So this filter is the, how shall I say, it makes everyone smarter, makes every trader smarter, makes every strategist better, and it makes even an imbecile a genius, basically. You can have a really bad model.
And I want to say that...
Yeah, you can have a really bad model, and you overfit it and whatever, and now you're trading it. But if you add this trend following thing as a filter, it will save you. And if you have a good model, it will make it better. That's just what I want to say.
Well, I was sort of with you up until the very end. I love all that stuff you said, but I do think that from where I come from, the reason it's going to work, the model, it needs to be good, of course. It needs to be back tested and have a good average trade. And basically what you're saying is trend following keeps you alive. But it's only going to work if you apply it consistently and follow those rules consistently. And so introducing trend following or trend following principles into a sort of a fundamental system, for instance, I mean, it may keep you alive longer or forever, but it's introducing inconsistent behavior. If you don't adopt a systematic approach with price rules based upon price and trend, and you try to mix it all up into a little bit of fundamentals, a little bit of trend, I don't know that you're going to have the same type of consistency that a trend follower might have.
I agree, Jerry. No, I think you misunderstood me. I didn't mean to say that somebody who's a discretionary trader or a fundamental. I'm talking strictly in the universe of systematic strategies. So just to give you an example, let's say somebody is a value trader and he only buys stocks with P ratio under 5. Or somebody looks at value and growth. So I don't know, low PE and then earnings growth. So he's looking at, I'm only buying stocks that have earnings growth of 20% 2 years in a row. So let's say that's a model. So he has a model. So he's scanning the whole universe, looking at all the stocks that have grown 20% a year, 2 years in a row, and he buys them. So this is strategy. He's systematic. He's not discretionary. What I'm saying is that if he adds a simple momentum factor to that, let's say, yes, you want 20% growth, you want all that, as you said, in the system, but add to the system, not as a discretionary inconsistent overlay, but add to the system some kind of price confirmation. So it has to be in an uptrend. It has to be, the trend has to be up. And if it's not up, don't do it. Wait until the price confirms it. That's all I'm saying. So do it consistently. Add it to the system. Almost, I don't want to exaggerate, but almost every other system that I've tried and I've looked at is improved if you add this little extra condition for whether you should buy a certain thing or we should enter a position or not. If you just add this thing into the system, not just apply it inconsistently.
Yeah, that's good to know. I've often wondered if a strategy like you mentioned needs to buy dips and if it actually can be improved by trend. Oh, after if you guys noticed, I changed my pinned tweet. Oh, yeah, this is a very big deal for me. I'm always tinkering with my bio when people make fun of me on Twitter and they characterize my style of trading as religious-based or cheap, obsolete. I'm always trying to work in there those funny little things that people come up with. But Twitter limits the amount of, letters. So I can't really put everything in my little bio up there. But I did change my pinned tweet. I had one pinned for a long time and I really loved. And then I changed it recently because of a quote from one of the traders on Top Traders Unplugged. Oh, the guy from CFM. I like this guy. I like CFM a lot. I've read as much as I can get my hands on about CFM. And they're the smartest guys on the planet. And they trend follow. And they write these articles every now and then. And they're just loving on trend following. And I just really like to read those. And anyways, yeah, so this pinned tweet that I put up there, I thought was just absolutely fascinating. We may have touched on it last week, but I thought this was just unbelievable. His quote is, when you regress the SocGen CTA index with trend following, you get 85 to 90% correlation and 4% per year outperformance. Removing trend following from aggregate performance means there is nothing left. CTAs offer nothing above and beyond trend following. So all the stuff that they're doing, it doesn't even matter. It just probably, in some way, helps keep the fees, trend following beta is like basis points compared to trend following plus a lot of other stuff in some sort of attempt to smooth things out or give clients the impression that you're doing a lot more work, so you deserve more fees. But anyways, I thought that this was just a fascinating thing that it's only about trend following.
Yeah, but that totally makes sense. And that's a great pin Twitter. And it goes along the lines of what I also just said. And I didn't mean to say that trend following needs anything else to be better. My conclusion was that trend following or momentum as a factor, as a filter, improves everything else. But there's nothing else like trend following that improve everything else.
When you say momentum, the majority of the people will recall the relative momentum absolute, yeah?
Yes. I say momentum because a lot of equity guys and stocks guys use momentum. It could be auto momentum or cross momentum. So it's momentum or cross momentum. For them, momentum is just momentum. So you can either look at the absolute, like on a one stock against itself from a year ago, or one stock 1 year performance against another stock's 1 year performance. So that's relative. And they both use the word momentum in the scientific and especially in the equities, in the stocks universe. They don't use trend following. Trend following is mostly like a CTA term and commodities term. But this is just definitions and languages. When I interchangeably use trend following and momentum, I refer to the same thing. Basically, if it's going up, you should be long, and if it's going down, you should be either flat or short. So that's what I mean.
You know, it's interesting. The discussion with CFM, that brought something to my mind as well. So I think when we're dealing with trend following that also starts looking into multi-strat as a way to smooth the returns, I think this is where the debate comes from. So I would maintain that adding trend following to any traditional portfolio does two things. It helps smooth returns by virtue of the fact that it tends to be uncorrelated with, and also during periods of adversity, it tends to come to the rescue. But that's one thing, smoothing returns. So yes, when you do add trend following to traditional portfolios, such as 100% portfolios in stocks, or 60-40 portfolios, stocks and bonds. When you add trend following programs to that, I've just done a little research project with Niels. I've found that in every instance, it produces a higher Sharpe ratio. That's smoothness. But there is another thing going on as well. The trend following programs give lifting power to the portfolio. So when CFM says that when they do that regression over the CTAs, they find that when they extract trend out of it, the other components of those programs aren't offering anything. They're referring to lifting power. And this is what trend following programs do. It gives it gives you the smoothness through the addition of it into a traditional portfolio, and it gives you lifting power. And this comes to a conversation that Niels was talking about with Katie Kaminsky, where he was saying we shouldn't be looking at individual programs in terms of Sharpe. We should be looking at it in relation to their portfolio. So he preferred to talk in terms of portfolio Sharpe. But I'd say, well, I actually disagree with that still, because when I look at how Sharpe deals with a trend following return stream, where we get the significant step-ups from outliers, it actually penalises a trend following program through beneficial volatility. So it will therefore always mean that if we're using program Sharpe as a way to assess between alternatives, we're always going to be penalising trend following programs that give this beneficial uplift in the or the lifting power of the portfolio. It's going to be penalising them. So I don't think we should be using program Sharpe, because I think that does trend following a disservice when we are comparing that to alternatives. Because if we're using Sharpe, they're automatically going to go to multi-strat, where it smooths things, but it doesn't give any of this lifting power. So I think the further we can keep away from the concept of Sharpe, the better it is for the industry as a whole, the trend following industry as a whole.
Yeah, and I agree with Niels when he said it for many years, that I don't know if it's true or not, but I'm sure it is, that Sharpe was never meant for one to be applied to an individual manager. It was meant to be applied to the entire portfolio. So how do CTAs help the entire portfolio? Run your Sharpe with your allocation to CTAs. The DG guy, I think it was DG I was just listening to, and he was like, oh, if you go by the numbers, it's 30 or 40%, but I would never do that. So you have managers who pay attention to numbers. They see their own numbers in their own style, and they're so conditioned to say, oh, it's only got to be a 5 or 10% allocation, even though it's what I do for a living. And but the CTAs, managed futures CTAs, they don't agree with that. they can say that all they want, but anytime you have this dynamic position sizing, and other people have said this before, is that at the very time you may need your CTA to maintain that big short position in stocks that he's had on for a while with massive profits built in, they're likely to be reducing that because of dynamic position sizing, vol management, correlation management, smoothness. So, my guess is that obviously that the classic trend following needs to maintain these positions from in order to help the traditional portfolio overall, and not at the exact wrong time start reducing these beautiful trades that that could potentially turn out to be very necessary when there's a big sell-off in the stocks.
Hey, good morning or good day, everybody. I was just thinking back when you guys were talking about adding new data and how to weight it. I had kind of an interesting experience with that recently. I've been working collaboratively with another trader, kind of helping verify their back test results using my trading back testing environment, and I was able to take a system and add data in the past to it. So instead of testing from like 1990 onwards, go back to like the late 70s. And I was kind of pleasantly surprised to find that longer term trend following systems, you hear people talk about how trend following has lost its edge, and returns have come down and drawdowns have come up. Testing kind of a pretty simple breakout system, I see a pretty similar max drawdown from the early 80s than you find kind of in what everybody calls the CTA winner. And to me, that kind of shows that, trend following hasn't really lost its edge or lost any of its expectancy. It's just people aren't looking back far enough. And I wonder, Jerry, if there was any, I don't know how much back testing Rich and Bill did on the systems that you guys traded, but I wonder if some of those shorter term systems that you guys were trading in the early 80s were kind of as a result of trying to stay away from that big drawdown that happened in the very early 80s, had they been trading longer term systems. Do you remember any talk of that when you guys were doing your turtle gig?
Well, I mean, I think the parameters that were chosen for us to trade a lot of those were just chosen based upon the personalities of the people choosing them, and then the goal was to make 200%. So we had the big drawdowns. It just came from leverage and really aggressively trading, with large size, and then having drastic cutback exposure cutbacks if you had these drawdowns, 10%, 20% drawdowns. So it was they had no trouble with the drawdowns. But I think it was just, their kind of personality I remember asking Rich about, the stop loss. So the program lasted 4 years, and then we started our own firms, and then we started doing our own back testing. We never really did any back testing while we were with those guys. They just did the back testing. They told us what the back test said. And so I asked him one time, I'm like, oh yeah, we did this back test, and the stop loss that you had us using we found it was really suboptimal. It was really too short term, and you were getting chopped up, and your win percentage was low. And his response to me was, oh yeah, that's just my personality. So we were sort of more leaning towards not allowing our personality to influence us and just trying to figure out the best way to trade. And my research was the same, is that, as I've said many times, the long-term stuff, when we switched over in the late 90s from shorter term to longer term, the long-term stuff, it always worked just as well, if not better, than the shorter term classic trend following. And then I had this discussion, or tweets back and forth between Absolute and me, where I was reminding that, my research that long-term, that the classic trend following that doesn't adjust for correlation, dynamic position sizing. Yeah, I think I don't know. I still don't think I know what dynamic position sizing is versus a combination of volatility management and correlation management. I think it's the same thing, but they get awfully uptight if you don't use the correct words. So anyways, I think I mentioned this on a podcast with Niels a year or two ago. And then I don't know if Richard, I think at one point Richard disagreed. Now maybe he does kind of agree. I don't know if he's done this research, but my research shows that if you, the longer term systems, without any dynamic position sizing, they have a tendency to make money almost every year. So you're giving up the smoothness, right? So is there no downside to this smoothness? It's just a whole winning game. I mean, it's just so obvious. And there's nothing, it breaks all the rules of finance. There is no downside to it. There's no compromise. But I think that there is. Because I think that without smoothing, the systems become more consistent on an annual basis. Like I said, we went back and did a back test back into 1977, and it was one of our systems, and it never had a losing year. So, I mean, that's unrealistic, but they did it, and they did it very fast, and I'm sure some of the years were positive less than 1%. But I do think that that's what they sacrifice, is the trailing 12-month return is going to be a little less consistently positive if you're trying to smooth things out. And but it's like the market saying, look, if you're willing to sit there and take all this crap and all this drawdown and all this volatility that almost no one can handle, yes, I will give you this. It will be very, very consistent, maybe the most consistent strategy over trailing 12-month return. So that's about all we can say to people, is that we do have a tendency to have winning years, high trailing 12-month trailing returns. 90% of those returns will be positive. But it does require you to not attempt to do any smoothing.
See, Jerry, can I ask something? So I think there's something contradictory for me here. So on one hand, you're saying the non-smoothness, so the bumpy ride kind of ensures or implies high percentage of winning years, 90% winning years, which is smoothness. So for me, I don't know how you can have one without the other. If for me, I mean, I'm just pulling this out from my experience and memory. Like if somebody told me, hey, I have a strategy that doesn't have a losing year, I would immediately assume that this is a sharp more than one strategy. It's a strategy at least one or more, because strategies that are less than one sharp have losing years. So but then you're saying I can be very bumpy, which means low sharp. I don't care about sharp, and then not have a losing year. I don't see how that is possible. The fact that you have high percentage of that trailing 12-month returns are almost always positive. So 90% of trailing 12-month returns are positive, to me suggests a high, sharp, smooth strategy. So how do you reconcile this?
I think it's a couple of things going on. One is that, in my opinion, I know you're not going to like this, but I think with the dynamic position sizing, you can just never get away from the fact that it has some issues with overfitting and more rules and more parameters. And so obviously something with less rules, less parameters is going to be more robust and more consistent. And then I think it's the power of the outliers. I think this is what it's saying, is these outliers, these outlier trades, they can create so much volatility. You know, the orange juice is a good example. I mean, every time I look at this quote, it's like it's down limit or it's up limit, right? But it's still in this big uptrend and it's still producing that profit. And so I think the power of the outliers and the frequency of them, we underestimate the frequency. Even at 5%, they're able to push us over the finish line if given enough time. So it's two entirely different things. It's this massive outlier, the 5% of the trades on average, or something like that, 5 or 10%, or sometimes it's 0% or 1%. They're so volatile and they're so crazy that they're really causing havoc with being able to stick with the system and enjoy this investment. And that's why they're gotten rid of by the largest CTAs. But they're so powerful that given enough time, 12 months, that they will push you over the finish line with a huge profit and help you have those profitable 12-month periods. But look, you made 20%, but you were up 40 or 50. So this is not illogical. And it proves back on the back test. I'm not saying, and then the only reason I would say replace every year with trailing 12-month return is because every year you could make profit. It would be totally luck because of the calendar. So in anticipation of being criticized for, I mean, I think the first 5 or 7 years we were in business, we made money every year, but we had tremendous volatility. We only started getting in trouble when we tried to adopt some of the smoothing techniques that we heard other people were doing.
Yeah, I'm still. We were also having a discussion on Twitter. This was last week about outliers, and there was this other guy that came in, and I don't know, riding on a high horse, and then he left and he blocked Rich, and I don't know if he's here and listening. For me, this, and yes, there was a debate also, not debate, but discussion about what is an outlier. And I wrote a couple of tweets kind of explaining my explanation that outlier is really a strategy dependent, as we all know it. Outliers don't just sit in the price series and everybody sees them, oh, there's an outlier or not. Outliers happen after a price series has been transformed with a strategy. So the price time series have been translated into a P&L time series or a trade time series, and that's where the outliers exist or they don't. And one price series can be transformed with one strategy, and same price series can be transformed with another strategy. One strategy could produce less outliers than the other, and they could make the same amount of money, or the strategy that's producing less outliers could even make more money than the strategy that's producing outliers. But that all depends how outliers are defined. When we had these examples about 50R outliers and whatever, another strategy that never has a 50R outlier can have 10 5R outliers, not outliers, but 10 5R trades capturing the same thing. And the total is 50R, but it never shows on the distribution. On the distribution of trades, there's never a 50R trade. Therefore, this strategy does not capture outliers, but it captured the same price movement. It translated the same price series into a P&L series that corresponds to the other P&L series, or close enough. Even though one does catch outlier, the other one doesn't. And so this whole discussion about how outliers are some kind of otherworldly, non-linear, non-real, chaotic, undescribable, unpredictable things. Therefore, we can never analyze them. And I honestly don't buy it. Even when you're hunting outliers, we are discovering, as everybody else is discovering, the more you diversify, the smaller your bet size, and the more you diversify across systems and markets, you find more outliers, each of them smaller. But why are you doing that? So that you increase their frequency. You will still have 5% of, maybe again, still 5% or 10% of your outliers of trades will be outliers, but you will have more trades. Therefore, the frequency of these jumps, of these so-called unicorns, is going to be more distributed in time, more uniform, and your equity curve is going to be smoother. That's why we're diversifying. And I also don't agree that a strategy that hunts outliers, let's say somebody wants just outliers, produces a non-linear equity curve. It will be linear. And the more you diversify, even if you're hunting outliers. So let's say you went from 10 markets, each trading 2 systems. So for 20, ensemble of 20. And yeah, you capture 3 or 4 outliers a year, and or 0, and then your years are going to be very different whether you capture them or not. And when you capture them, it's going to be like a lottery win, and everybody's going to go, wow, you're having a great year. But why aren't you staying with 10 markets and 2 strategies, or ensemble of 20? Because you never know, because you want to smooth out. You want the outliers to happen more frequently. Why are you doing that? To smooth out your equity curve. The only reason why you go to 100 markets and 20 strategies, so to an ensemble of 2,000 versus 20, is to smooth out your equity curve, is to spread out your bets to more. You're actually buying more tickets, you're buying more bets, and you're hoping that ensemble of 2,000 is going to create more outliers per month and per year than an ensemble of 20. You're doing it to smooth out your equity curve. And the more you diversify, you improve your performance. The more outliers you catch, the more linear your performance becomes, and the more your equity curve becomes similar to the equity curve of the other guys who you're saying are not hunting outliers.
Actually, the argument is, so what we are saying is, at the end of the day, we have more Kager. And I think that's where the disagreement happens,
Sorry, can you repeat what? You have more what?
Kager, more lifting power.
That is wrong. That is wrong. There's no more
But this is
lifting
where
power.
but that's what the debate is. So in my view, one of the main advantages of those outliers is your performance is way, way better than someone else who's cutting those winners short. So that's the thing. And in the past, I have tested it with my quant model. But the only thing is, I was just cutting them short. I wasn't getting in as well. So I've just tested halfway through. And of course, when you cut your winners short, right, it's only natural that your performance is going to be smaller, right? So there are no surprises there. But what Niels has mentioned is their models is not only cutting them short, but also they are, scaling in when the volatility gets back down. So they are re-entering into the trade that they have already scaled back in. So I haven't tested that. But the main argument why these outliers or no outliers is, so, Mister, we have more performance, more Kager. So this is what we think we have.
Yeah, and
Can I explain something just here? So I'm just looking at a back test I did on this latest model I did in February. And I've got 55 return streams here. Now, the bottom 20 return streams produced individual profits of around about, this is on a 200,000 hypothetical portfolio, that produced around about between $10,000 to $20,000 per market for those 20 markets. But the top 30 of those markets, the best one, USD JPY, produced 170,000 on its own. Bitcoin, 164,000 on its own. Soy oil, 118,000. Copper, 102,000. London sugar, 93,000. So if you can't see the difference between a linear series and a non-linear series with those numbers I've given you, I really don't understand how to describe it. What we're talking about is those return streams that possess those outliers, those top 30 that I was talking about, they magnify the returns as opposed to those that do not have outliers in those series, those bottom 20. So there's two things going on here. One is we're applying an ensemble of trading systems, trend following trading systems that are specifically targeting outliers. So what I mean there is that they're not on all the time. So when you're applying an ensemble of trading systems, let's say you have 10 trading systems, then during the majority of minor price movements, when you happen to find that your trend following models are triggered, there might only be 1 or 2 or 3 at max models being triggered. However, when you are actually attacking an outlier, when you get that material price move, you suddenly find that 10 of your systems are being triggered. So we're getting the benefit of the small bets. We're during adverse times, we might have 1 or 2 systems being active. But when the outliers are present, we're suddenly finding that 10 of our systems are being active. So we're getting 10 systems with loose pants applied on a single outlier. You're getting 10 times the magnitude of that price outlier. So that is what is exponentially magnifying the returns of your return stream. That's what's giving you your 170,000 return for USD JPY last year versus a very ordinary market like cocoa that might have only produced 10,000 over the 30 years. It's this non-linear magnification that we're talking about here, and we're finding that trend following offers this asymmetry in this non-linear magnification where other models that are cutting losses short and just focusing on taking profits at maybe 1R or 2R or whatever, they're not getting that benefit.
Well, no, I agree. Trend followers are not cutting their profits short. So we're not discussing that. Nobody's taking 2R profits.
But you're saying we're getting a smoother equity curve through our outliers because we're getting more distributed outliers throughout the series. Totally agree with that. But that is a non-linear series. It's not a linear series. So we're getting a smooth equity curve of non-linear events.
Richard,
which is magnifying CAGR. It's lifting CAGR.
No, let's get to the bottom of this. Okay, here. Okay. Can you, I asked you and you avoided answering me my tweet. If in your current ensemble, I don't know, you have 10 systems per market and how many markets? Let's say you have 10 systems per market and 100 markets. In your current ensemble, after your last rebalancing, you produced an equity curve, right? You can produce a backtest and an equity curve.
Yep.
Is that equity curve linear or non-linear?
Non-linear. I'll explain it this way.
Okay,
let's take one market. Okay, so if I took one market,
total portfolio.
Okay, no, I need to explain it this way. So of that total portfolio, 30 of those markets I've just said are non-linear, 20 are not effectively linear outcomes over a 30-year backtest. Okay, so let's look at one of those markets. Because USD JPY produced $170,000 profit versus cocoa that produced $10,000 profit.
So
there was a magnification of profit. Because divide 170,000 by 10,000. You've got a 17 times order of magnification in that profit. It is a non-linear relationship. It is not a linear 1-to-1 relationship. It's a 1-to-17 relationship. And if I look at the equity curve of USD JPY, when USD JPY last year in 2021 was producing this supreme profit, if I just look at USD JPY, I've got 20 years of paltry performance, and then bang, I've got this massive outlier that lifts the entire equity curve. Now, if you plot that trajectory, that is a non-linear exponential curve for one market. And I've got 30 of them. So I've got 30 non-linear exponential curves that when they consolidate, it looks linear, but it's not linear. It's actually made, that portfolio equity curve is made of non-linear outcomes.
But the total equity curve is linear. You just said it.
That's only because I'm diversifying my systems, I'm diversifying my markets, and I want to distribute outliers across my time series. I don't want all of my outliers to occur at one point. That's right. So what it's doing, though, compared to other models that are not targeting that non-linearity, When you compare the models, you will get two trajectories. The linear model will have no lifting power, but it will have a rising smooth equity curve. But when we overlay the trend following equity curve, we'll get a much steeper ascent from the origin. And that difference between the steeper ascent and the less steep ascent is an exponential power law.
Okay, but you just said your portfolio equity curve is linear, my portfolio equity is linear, equity curve is linear, but yours somehow has some CAGR and lifting power which mine doesn't have.
If I excluded all the other markets and I just had USD, JPY, and those 10 markets that were non-performing in my portfolio, so 11 markets in that portfolio, the influence of the USD, JPY last year is going to give that entire 11 market portfolio an uplift last year. That uplift you'll see as a rising curve.
Yeah, same thing with me. Every year I have markets that outperform other markets by 10 or 15 times. Or over every 2 or 3 year period, if I rank them by best performers and worst performers, I have things that kick the ball out of the park, and then others that don't, and they keep rotating, which is why I'm always trading a whole portfolio, and which is why you are always trading a whole ensemble. You're not only picking the best 30 ensembles and markets from last year and trading them this year. Therefore, the conclusion is that however your system is and however my system is, both in backtest and in real life trading, we're producing linear equity curves if we're not compounding. Do we agree with this?
No, because, okay, the portfolio equity curve I've got, if you look at it, if you blow it up and zoom in, you'll find it's a stepped equity curve. It's not a linear equity curve.
It's stepped, but it's linear.
No, you can't call a stepped equity curve a linear equity curve. If you've got, say, from 2000 up to 2005, you've got a linear equity curve, and then in 2005, you've got a big uplift to create a step. And that step doesn't deteriorate, it just plateaus or keeps on going up. And then you get another step and then another step. If you plot the line of best fit across that equity curve, it'll be an exponentially rising curve. If you did a line of best fit, line S, regression function, exponential function, you'll find that plots that curve the best because it's stepped, it's not linear.
So you're telling me that for your whole portfolio, without compounding, your CAGR is increasing with time?
Yes.
Wow. Okay. Well, I don't know what to say.
Yeah, but this is just my issue. I try and explain these things, and seriously, I have massive trouble trying to explain it to people.
And I don't mean to be argumentative. I really do want to understand what you're saying. And I don't think that your current equity curve of your current portfolio, if you run it a 30-year backtest and show me the equity curve without compounding, fixed amount of systems, fixed amount of markets, and show me the
I've
equity
already
curve.
done
It's
that.
going to be a linear.
On Twitter. I gave that to you.
It's a linear
blow
curve.
it up. Zoom in. Don't just look at it from sort of a helicopter view. Zoom in. You'll see it stepped.
I don't have to zoom in the steps. They could be steps, they could be going out linearly. Steps can go out linearly like a staircase, or they could be going up exponentially. If your steps are going up linearly like a normal linear staircase, you have a linear equity curve. I don't care if it's steps or jiggles or ups and downs or a straight line.
Okay, but the reason why, this is narrowing down to where we've got the slight disagreement. All I'm saying is that simply through my process that I'm able to distribute outliers across the time series. If I was a traditional trend follower that was just looking at big moves in 2008, big moves in 2014, big moves in 2022, you'll see three major steps in that portfolio at those points in time. Now, we might get three major steps, but they're not going to be the same size steps. Some steps are going to be smaller than others. Some steps are going to be massive compared to the others. When you plot a line of best fit over that, you will not have a linear function. And the only reason I'm getting what looks to be like a linear function is because I'm deploying ensembles of systems, multiple systems, And my method and process is trying to distribute those outliers as evenly as possible. Even though I don't know when they're going to occur, I'm trying to distribute as many of them across the series so that there's outliers that are building the equity curve. I've got 11,000 trades or 14,000 trades in my back test. Only 236 are actually doing any of the lifting power in that 14,000 trades. So that's why you've got to zoom in to have a look, because you'll find that it's not evenly distributed exactly at all points along that equity curve. There are points in time where we get big steps, but it's just hard to see.
Okay, is it possible? Okay, would it be possible that those big outliers are in a 20-year backtest? What if those 240 big trades outliers most of them were concentrated in the first 5 years of the backtest, and then the next 15 years where there kind of less and less of them? Would that be an exponential equity curve, or linear, or some other curve?
It would be quite a terrible polynomial function. It's not going to be linear,
okay.
but it's going to be a massive uplift and then a deterioration or a stagnation and then etc.
So in order for your KGAR to be increasing in time linearly, consistently with this lifting power, you have to ensure that both in your backtest and going forwards in real trading, the frequency and the size of outliers in your fixed ensemble has to keep increasing.
If I had 14,000 trades across my entire trade distribution and only 236 were outliers, and let's say that they were greater than 5R, what I was classifying as anything that was greater than 5R, let's call them an outlier, and greater than 5R up to 100R would be things I'd classify as outliers, things that are beyond the magnification of the bulk of trades, the 14,000 less 236, that was sitting between minus 2R and plus 5R. So when I look at those trades are all represented in that equity curve, but they're all effectively a random series. They are what is interdispersed between these outliers, these 236 events. And, you get plateaus, you get lots of plateaus, you get lots of uplifts. When you look at the details of how that overall portfolio equity curve constructs at the end, compiles together, you do get periods of stagnation, you do get periods of uplift. However, when you blow it out, it looks as though it's linearly, increasing, but it is not a function of that. It's a function of the fact that nearly all of the trades are doing nothing to the lifting power, but 236 of them are doing all the lifting power.
I agree. Let's say I accept that. Now, my argument here and my misunderstanding, I'm trying to understand here. My claim is that, and what I also think you're also trying to achieve, is to spread those 240 outliers as evenly as possible across the 20 years. You don't want to bunch them up in the first 5 years. You don't want to bunch them in the first 5 years. You want to bunch them in the second 5 years. You don't want to bunch them all up in the last 5 years of the backtest. You want all of them to be distributed uniformly. Now, my claim is that if they're distributed uniformly across the whole 20 years of the backtest, and if they're approximately more or less similar size, those outliers, you don't want one to be 100 times the others at a certain time of the backtest. If they're uniformly distributed over the 20 years, and if they're more or less the same size, you will produce a linear equity curve.
Yes, I agree.
Okay, and in the only way to produce a non-linear equity curve is by some kind of magic or a curve fitting or backtesting miracle, or somehow you slowly bunch them up and pile them up starting from the last 20, 15, 10, and then kind of bunch them all up in the last 5 years, where like in the first 5 years you have 10 outliers, in the second 5 years you have 50, in the third 5 years you have 85, and in the last 5 years you have like 140 outliers. So if the uniformity...
Agreed.
If the distribution of the outliers is this way, then only then you will get an exponential equity curve. But I don't see how you can achieve that by design. How can you
No,
bunch up
you
all
can't.
the
You can't
outliers?
predict it. You can't predict it. So this
Exactly,
is what
exactly.
I'm saying. Okay, so this is what I'm saying. I'm saying that trend followers aren't working hard enough to find their outliers, because I've got 30 markets that I can show in a 55 market portfolio that clearly have outliers. Now, Mike Harris was only talking about Bitcoin. He didn't even refer to USD JPY, which was last year, which was my biggest outlier of all time. There were so many markets: soybeans, London sugar, steel. All of these things are all giving these magnificent outliers. Now, we can never predict the size of them, so we don't have the luxury of a process that allows us to say, I want them to be all the same size. It is what it is. But with an ensemble of systems, you're also getting a magnification of the impact of those outliers. Now, in my world of trend following, I want this rising equity curve, but I want those step ups, because step ups, to me, there's nothing bad about them. They're all beneficial. They're penalized by sharp, but they are all beneficial. So the more step ups I can get, I don't care how well distributed the step ups are, provided I don't significantly, well, if I can distribute these outliers as good as I can with my process. And that's because I'm highly diversified using an ensemble of systems, which I believe has the ability to magnify outliers when they are present. And I'm thinking that my process is actually generating these series which are not giving me that CTA winter, because I'm finding, I might have a 3-year period at max, which is a stagnation or a building drawdown period. And that is because of the process. It's not because of prediction. It's because of the process of how I'm applying this entire process to generating these portfolios.
Richard, what do you think is the when you do that analysis that you just spoke of? What do you think that the CTA, the managed futures CTAs, weren't doing, that when they come back and say, "Oh yeah, it does look like a CTA winter"? Not trading enough markets, not trading enough stocks or single stocks, or not letting profits run fully like classic trend?
Look, my gut feel, Jerry, is that they weren't adaptive enough. In other words, the CTAs that entered that winter, and a lot of them were represented in the SG trend, because when you look at SG trend, it does have this winter. It's not 10 years, by the way, because 2014 was a great year for all forms of trend following. So it's about 6. But anyway, I think that the big trend followers, they came in with models that were basically developed over the last 20, 30 years, but I certainly don't think that those models were flexible enough to handle the trends that did occur during that decade that they're talking about, that were not actually exploited by those firms. So when I'm looking at my back test now, I'm looking at, there's a hell of a lot of currencies that gave me significant outliers during that decade. I don't trade single stocks. I trade a lot of currencies. I don't trade bonds either. I trade a lot of currencies, trade a lot of commodities. I trade equities as far as indexes are concerned. But my currencies, a lot of the currencies were doing very well during that period. And I noticed that a lot of the CTAs had very little currency exposure. A lot of them were, commodity focused or whatever. So, the level of diversification, what the markets that they'd diversified in were markets that had performed well over the past 30 years. But over this particular long winter that they talk about, I think there are different markets that weren't necessarily represented in their portfolio that were giving outliers. And so this is where this max diversification comes in. I think that they came into this winter with too little diversification. And that's why they suffered this performance. And it took a long time for them to recognize that they needed to either adapt or change their models. And so some of them, like Harding and people like that, decided, we better get away from trend entirely. But it was because I don't think that they were sufficiently diversified in the markets that were actually performing during that period.
I agree with Richard. I think it's purely market and system diversification.
Yeah, it's so difficult to.
I didn't have no winter, so
it's so difficult to keep trading markets that haven't performed well, commodities especially. We kept the commodities in, the currencies in. It sort of mystifies people. Like, you made all this money, CTAs made all this money long bonds, what are they going to do when bonds go down? And so you're like, well, we're going to sell that breakout, and we're going to sit back and hold on. And it happens. And they seem to be somewhat mystified by how we do it. Seth, did I answer your question?
Yeah. I mean, for the most part, I think so. I just thought it was interesting how you see so many people talk about a loss in performance, and it doesn't appear to me that classic trend following has lost any performance at all.
And so often, when I see statements and questions, you just know if it's not explicit in the statement or the question, you just know that. And this happened, I think, this week, and that guy that Rich blocked. I mean, Richard should have blocked him. I had to block him because some people just don't have good manners. But once again, it's just we're talking past each other because the evaluating systems and implicit in people's brain is sharp, and they don't even say it. It's just you're supposed to know it, and I just don't live in that world. I don't accept that world to evaluate systems and evaluate performance. I don't. It has nothing to do with sharp and volatility for me.
Yeah, I mean, actually, it would have been nice if someone else, if one of us had a model that can actually show the characteristics of a trade with the dynamic position sizing, where you scale back and scale in versus the way we trade, let's say, US to Japanese yen. But at the moment, we don't have that. So it might be worthwhile having someone else, having a guest here, someone else who's running a model like that. I mean, absolutely, you're doing dynamic position sizing, don't you? I mean, for a similar trade in USD Japanese yen, like without, I'm just saying one trade because it would be very complicated to do it in a portfolio and in multiple systems. But if we just gonna do it in one trade, just to make the point over a very long year, like maybe 30 years, and if we just compare the performance of it between a classic trend follower and your system and how did it perform over time, and just to look into it, or maybe not one, maybe two or three, but very very simple, extremely simple portfolio. I mean, would that be all right to have a comparison of the CAGR or the key stats, perhaps?
Yeah, I don't think I can segregate it that way because I don't look at my positions as a trade by trade. So I could, but it's gonna mangle up the system. What I've noticed, just like I've noticed that momentum and trend following improves every other strategy if you add it as a factor, as a filter into the strategy. I've also noticed that um, volatility adjustments on a singular basis on a position size, it also improves every strategy. So adjusting to volatility and trend following improves every other strategy that I've looked at on a single market basis and on a portfolio basis. And I've run these comparisons that you just said myself. I've run them maybe 15 years ago, and I could not find a single market, let's say USD JPY or any market, in which volatility adjusting to volatility hurts performance on a sharp or a MAR basis or whatever. So for me, the conclusion was 15 years ago that this is a freebie. This is almost like a free lunch.
True. However, as I just got finished saying, you have to introduce vol and sharp. That has to be your God. You have to worship that. They must introduce that. If they can't introduce that, then it all falls apart.
But Jerry, what are we comparing then? What are we comparing? How does one outperform the other? By what measure?
I think, once again, as I said earlier, I think it's hard to get away from. We try, but I think that it's not. Our ultimate idea here is that you can't get away from the fact that the one entry, one exit, one stop loss has fewer parameters and fewer variables, and that is something that's preferable.
I have less. I have less.
And once again, well, when you're adjusting and you're doing all these trades for increasing, decreasing correlation, volatility, I don't know how you say that's less, but and so I think that what's like I said earlier, the performance of the trend following systems without dynamic position sizing is more consistently profitable on an annual or trailing 12-month basis. And then another thing too is, and all the research that I've done, and it's getting too many concepts in my head, but as Richard said as well, it's kind of the same thing as sample size and variables and parameters. It's the data is more fitted to historical price patterns and trends, because then the one entry, one exit, and a stop loss is does not depend upon as much as the markets. The loose pants allows the markets to have more different future trend performance and what those trends are going to look like. And so so I think that is not to be discounted. But yeah, I lost my train of thought, and my wife just came out. I need to go skiing with her. So anyways, I'll say goodbye, and I hope everybody has a good weekend, and we'll pick it up next week. And